Hi, my name is Pieris Marcou, and I would like to welcome you to our quarterly tax update brought to you from sunny Nicosia in Cyprus. The main aim of our quarterly tax updates is to give you some high-level insights to major tax developments in Cyprus and brief updates on developments around the world that may have an impact on companies operating from Cyprus. In today's webcast covering the period from April to June 2015, we will look at changes in local tax legislation that were enacted during this period. We will update you on a new treaty protocol and a new tax treaty signed during this period and briefly cover some important international tax developments. We will close off with a quick reminder of the tax deadlines coming up in the next quarter. We will start with the local tax developments, that is, changes in the tax legislation that have been enacted during the quarter ending 30 June 2015. We will also look at some proposals for tax changes in the tax legislation which are currently being considered by the Ministry of Finance. Last April, we saw the voting of the various laws concerning the restructuring of loans. Within these changes, two tax laws were amended that are within the scope of our webcast. The capital gains tax law was amended to provide for tax-neutral restructuring of loans. According to the amendments voted into law, gains arising from the disposal of the principal residence are exempt from capital gains tax, provided that the principal residence is for the exclusive private use of the owner, the sale consideration does not exceed the amount of €350,000, and the disposal of the principal residence is made in the context of loan restructuring, compromise or an approved arrangement plan, personal repayment plan, court order for the liquidation of a company, Part 6A of the transfer and mortgage of immovable property law, i.e. the disposal of mortgaged immovable property by the lender. The above exemption applies on disposals made until 31 December 2017. Any disposal of immovable property other than the disposal of a private residence, which are made in the context of a restructuring, is also exempt from capital gains tax. The above exemption applies for any direct or indirect disposal or transfer of immovable property or movable property that would be made until 7th of May 2017. A number of other amendments provide for the method of calculating the capital gains having regard to the selling price and the amount agreed for the loan restructuring. The second law that was amended was that of the Department of Land and Surveys law, which was amended to provide again for tax-neutral loan restructurings. According to the amendments voted into law, no transfer fees are charged on the sale or transfer of immovable property where the sale consideration is less than €350,000 per owner, and the sale or transfer has resulted from A, bankruptcy in accordance with the bankruptcy law, liquidation of a company in accordance with the company's law, sale of immovable property in accordance with Part 6A of the transfer and mortgage of immovable property law, that is, the disposal of mortgaged immovable property by the lender. Furthermore, no fees are charged on the transfer of immovable property to the lender in the context of restructuring. As mentioned earlier, the Ministry of Finance is currently working on a number of amendments to the tax legislation in an effort to improve the competitiveness of Cyprus in attracting foreign investments. Amongst the changes being considered are the following: introduction of notional interest deduction on qualifying equity. This change will allow companies to fund their operations from own capital and obtain tax relief for notional interest deduction, effectively reducing their overall effective tax rate. With the corporate tax rate at 12.5%, and depending on the level of capitalization of a company, the effective tax can be reduced to as low as 2.5%. extension of the 20% and 50% exemption on employment income provided to individuals commencing employment in the Republic. Currently, the law provides for relief for the first 3 years of employment. It is expected that this period will be extended. Introduction of the domicile concept in the special defense law. This will effectively mean that non-domiciled individuals will be exempt from special defense contribution on their dividend, interest, and rental income, even though they may be tax residents in Cyprus. It is expected that within the introduction of this law and the extension of the 50% exemption, Cyprus will attract top executives and high net worth individuals to bring their businesses on the island. There are discussions for simplifying the tax treatment of Forex. Also, there are changes to align the Cyprus tax legislation with EU directives and ECJ decisions. And finally, there are proposals for simplifying the tax laws on immovable property. Once these changes are voted into law, we will cover them in more detail in a special edition webcast. Finally, there are proposals for changes in the assessment and collection of taxes law, which will allow the Cyprus tax authorities to apply the automatic exchange of information. As you know, Cyprus signed the multilateral competent authority agreement and has committed to commence automatic exchange of information from September 2017. The MCAA is an agreement that implements the standards for automatic exchange of financial information in tax matters developed by the OECD. The standard provides for annual automatic exchange between governments of financial account information, including balances, interest, and dividends. As of June 2015, 94 jurisdictions, 61 of which have signed the MCAA, have committed to implement the standard for automatic exchange of information. Cyprus is also planning to amend the assessment and collection of taxes law in order to facilitate the automatic exchange of information between the Republic and other countries, and the relevant bill has been put to Parliament. Here is the list of all the countries, in addition to Cyprus, that have signed the MCAA. During the quarter April to June 2015, we had the signing of a protocol with South Africa and a new tax treaty signed with Georgia. Let's have a look at the details of these two treaties. On 1 April 2015, Cyprus and South Africa signed a protocol which amends the existing tax treaty between the two countries that is in place since 1997. Withholding tax on dividends. Up to now, there was no withholding tax on dividends paid by a South African company to a Cyprus tax resident company or individual. The new protocol provides for the following new rates on dividends. 5% withholding tax on dividends paid if the beneficial owner of the dividends is a company holding at least 10% of the capital of the dividend-paying company, or 10% in all other cases. Exchange of information. Article 26 of the treaty is replaced by a new article which is in line with the wording used in the OECD Model Treaty. The amending protocol will come into force after the two countries exchange ratification instruments. On 13 May 2015, Cyprus signed a tax treaty with Georgia. The applicable withholding rates for dividends, interest, and royalties are all 0%. The provisions of the tax treaty will come into effect on the first day of January following the date the two states exchange notification that all necessary procedures have been completed. The treaty is expected to encourage inbound investments into Georgia as it provides for zero withholding tax on dividends, interest, and royalty payments, effectively reducing Georgian domestic withholding taxes. For the international part of this quarter, I will briefly cover the ongoing developments with BEPS, look at some interesting EU developments around tax, and briefly refer to the recent law passed in Russia for voluntary disclosure by individuals. During the second quarter of 2015, the OECD released discussion drafts on the following BEPS actions. Action 3, Strengthening CFC Rules, issued on 3rd of April. The discussion draft contains recommendations on the design elements that the country should include when enacting a CFC regime. Action 11, Improving the Analysis of BEPS Rules, issued on the 16th of April. The discussion draft on this action focuses on improving the availability and analysis of data on BEPS, including monitoring the implementation of the action plan and evaluating the effectiveness and economic impact of actions to address BEPS on an ongoing basis. Action 8, Transfer Pricing Valuation with respect to transfer of intangibles, issued on the 29th of April. The discussion draft proposes revisions to Chapter 8 of the Transfer Pricing Guidelines on Cost Contribution Agreements to ensure that their application within a multinational group is consistent with the anti-money laundering principles. Action 7, Preventing Artificial Avoidance of PE Status, issued on 15th of May. The OECD has published a revised discussion draft which contains a specific preferred proposal with respect to each PE avoidance strategy identified in the first draft, based on the feedback received. Action 6, Preventing the Granting of Treaty Benefits in Inappropriate Circumstances, issued on the 22nd of May. The draft includes, amongst others, a discussion on the limitation of benefits clause, discretionary relief, and the treatment of collective investment vehicles. Action 8, Hard-to-value intangibles, issued on the 4th of June. The draft contains an updated section of Chapter 6 of the Transfer Pricing Guidelines, including a revision of the section on anti-money laundering pricing when valuation is highly uncertain, and adds a new section in relation to special considerations for hard-to-value intangibles. Other key developments in BEPS include the public consultation that was held on Action 12, Mandatory Disclosure Rules, on the 11th of May, in respect of the discussion draft released on 31 March. The draft considered the possible design options for a model mandatory disclosure rule and set out recommendations for the design of a disclosure regime for international tax schemes. An ad hoc group with members from over 80 countries, including Cyprus, was established in May to begin work on development of the multilateral instrument in accordance with Action 15. The group's first meeting will be held on the 5th and 6th of November. Country-by-country reporting implementation package has been released on 8th of June to facilitate a consistent and swift implementation of new transfer pricing reporting standards developed under Action 13. This initiative is intended to ensure that the tax administrations obtain a complete understanding of the way multinational corporations structure their operations while also ensuring confidentiality. What are the steps towards delivery? Adoption of the BEPS package by the OECD Committee on Fiscal Affairs is planned to take place around the 22nd and 23rd of September 2015. The package is to be made in the form of an explanatory statement together with all the 15 reports. Upon delivery to the OECD Council, the results of the BEPS project are expected to be presented to the G20 finance ministers in Lima on October the 8th and to the G20 leaders in Antalya in mid-November. In the meantime, during the G7 summit in Germany on the 7th and 8th of June, the leaders reaffirmed their commitment to finalize recommendations for the BEPS action plan by the end of 2015. On 27 May 2015, the EU and Switzerland signed an agreement on the automatic exchange of information with respect to financial accounts. Under the agreement, the EU and Switzerland will automatically exchange information on the financial accounts of each other's residents starting in 2018. Information to be exchanged concerns account balances and proceeds from the sale of financial assets, as well as certain income such as dividends and interest. On an annual basis, EU states will obtain the names, addresses, tax identification numbers, and dates of birth of their residents with Swiss bank accounts, as well as other financial and account balance information. The aim is to tackle situations where a taxpayer seeks to hide capital for which tax has not been paid. The agreement upgrades a 2004 agreement that ensures that Switzerland applied measures equivalent to those of the EU Savings Directive. It also complies with the automatic exchange of financial account information promoted by the 2014 OECD Global Standards. Currently, the EU Commission is negotiating similar agreements with Andorra, Liechtenstein, Monaco, and San Marino, anticipated to be concluded by the end of 2015. On 17 June 2015, the European Commission released its Corporate Tax Action Plan. The plan provides for the following: the intention to bring out a proposal on a mandatory common consolidated corporate tax base in early 2016, guidance and specific tools on transfer pricing and how to implement patent boxes, with a proposal on the latter to be released in 2017, improvements to double tax dispute resolutions, strengthening tax transparency via work on screening non-cooperative third country tax jurisdictions and developing a common EU strategy to deal with them. This includes 30 top listed countries presently assessed as non-compliant by the EU, implementation of automatic exchange of tax rulings. Along with the action plan, a decision has been taken by the European Commission to reform the Code of Conduct for Business Taxation, which tackles harmful tax competition in the European Union, enhance the platform on tax good governance, addressing aggressive tax planning in third countries. The EU Action Plan is expected to foster a coordinated implementation of the measures developed in the course of the BEPS initiative on OECD. The Russian law on voluntary disclosure of assets and banking accounts by individuals has come into effect as from 8 June 2015. The law introduces new provisions regarding the voluntary declaration for individuals in respect of their assets and deposit accounts with foreign banks. The law provides that a person who has CFC subject to tax disclosures may be exempt from the criminal liability for breaches of tax and customs legislation, administrative offense liability for unlicensed, unregistered business activity, and liability for non-compliance with tax rules and regulations. The law also provides for transactions with assets reported in a statutory disclosure are exempt from taxes. Nominee-owned assets other than monetary assets may be transferred to a beneficiary owner without any tax consequences. Persons who hold foreign bank accounts have an opportunity to obtain exemption from administrative liability for breaches relating to foreign currency transactions. Disclosure forms may be submitted from 1 July to 31 December this year. They will be kept centrally and will be confidential without any exceptions. We will close off today with the dates to watch out for during the next quarter ending 30th September 2015. 31 July 2015 is the deadline for the submission of the 2014 personal income tax return by salaried individuals submitting their return electronically. Electronic submission of the 2014 employer's return and the submission of the 2015 provisional tax return and payment of the first installment. I will remind that interest and penalties for the provisional tax return are imposed after the end of the month that follows the submission deadline, which effectively means that one can submit and pay their first installment by 31 August 2015, the latest, without suffering any penalties. It is worth noting that although the deadline for the self-assessment for salaried individuals was 30th of June, penalties and interest will not be imposed until the end of this month. A relevant announcement was made by the Ministry last week. 1 August 2015 is the deadline for the payment of the 2014 tax balance through self-assessment by individuals and companies preparing audited financial statements. Again, I would like to remind you that penalties and interest will not apply until the completion of a calendar month from the due date. So effectively, payment can be made by 31 August without any interest and penalties. 31 August 2015 is the deadline for the payment of the second installment of the premium tax for life insurance companies and the payment of the movable property tax for 2015 with a discount of 10% on the tax due. And finally, 30th of September 2015 is the deadline for electronic submission of the 2014 personal income tax return by individuals other than salaried employees who do not prepare audited financial statements. Also is the payment deadline for removable property tax for 2015 without the 10% discount, and the payment of the third installment of the special tax levy by credit institutions for 2015. This concludes our webcast for today. If you have any comments or queries on the items discussed during this webcast, please email us on cyprustaxwebcasts@deloitte.com. From me and the whole of the Cyprus tax team, we thank you and have a wonderful summer.